Hi everyone, welcome to my YouTube channel. My name is Tabitha and today we are going to talk about price to earning ratio, which is PE ratio. So we are looking at this under the topic of capital gain, investment or trading. So when you buy into a company, you're anticipating that the price is going to go up and you're going to earn something at the end of the day or after 2 weeks, after 1 year, after 3 months, something like that. So that is the topic of today. We are going to look at the price to earning ratio, PE ratio. Our previous video, we had look at the price to sales ratio. And today we are looking at price to earning ratio. So if you're new to this channel, please subscribe for more videos and I will appreciate your business. So let's get into it really fast and move on because I don't want these things to be boring. So agendas would be what is the price to earnings ratios, and then why is it important, and calculating PE ratio and the limitation. So not to waste your time, let's look at what is the PE ratio. The PE ratio is when you compare the price of the stock and with the earnings that the company generate, and then you get the PE ratio. And this PE ratio is good for you to predict if this company will have a future growth based on the current earnings. So you have to like do like the forward and the forward PE ratio, which is what will predict the future. So compare the price of the company's stocks with the earnings generated. So when we look at that, we can now look at the importance. So how does this ratio help you? It's part of the evaluation tools that investors use to evaluate companies to see if those companies are worth investing in. Investors use it to assess the potential value of the stocks. So this one really is self-explanatory. So you can see it just give you the potential that the value of the stock. So the next one would be overvalue. It's used to determine if the company is overvalued or undervalued. The company that is overvalued is if the price is higher relative to its earnings. So this company is overvalued. The next one will be if the company is undervalued or not. If the stock price is lower relative to its earnings, and then that company is undervalued. The next part will be it's help you to make informed investment decision, which is the focal point for us who are trying to be investors. So we need like a piece of information that will guide you to make your decision if this company is really truly good or not. Okay, so this one, that is number 4. So another important way why you want to know the PE ratio will be yeah, I think that's a hand. Calculate the PE ratio. The PE ratio, you will take the stock market price, the stock price divided by the earning per share price. So if you Google today the Facebook price, so that Facebook price, take it and divide by the earning per share of the Facebook company. So the EPS. Okay, so now let's see how it is done. So we have this table. So this is where you get the information that you use to calculate. So this is the market value of the stocks, right? The stock price, the one that you will put in there in the numerator. Okay, you will take 330.53, and then the EPS, which is earning per share ratio, is 2.05. So if you take this one, divide by this one, you get this value, which is the one that we are looking for, PE ratio, 161.23, and it is for Tesla. So if you get this type of PE ratio, you know is very high, and it indicates that this company has a potential growth in the future. So let's look at how it is now calculated. Take the value of the stock. The value of the stock per share divided by earning per share, EPS, 2.05. So when you get that, you get 161.23, which is exactly the number that we were seeing on the table. Now let's look at the limitation. So every good thing always have limitation, disadvantages. So is it transparent? Does it give us all the information that we need so we can really make decision? So the thing is, the PE ratio cannot be used alone, right? You have to use it with the other tools so you can really get accurate like information that you can use to decide if you want to invest in those companies, because all these ratios, they have their own limitation. So this PE ratio has a limitation that it does not consider debt. So it can only show you the earning that the company that have made, and whether these earnings were made on cash or the company borrowed other people money to come and make do business. It does not really show, so we don't know. You can say, okay, this company is good, look at the earnings, but maybe they have like 2 billion debt. So if they have that one, and then maybe you're putting your money inside, and in the future there's a problem, and the debt has to be paid before anything else. So that is a limitation. It does not consider growth. That's easy. Misleading when comparing companies from different industry. If you're using PE ratio to compare companies, it has to be those companies that are in the same category, in the same industry. Those are the companies that you compare. It does not consider cash flow. Yes, it does not show you cash flow, whether the company is cash flowing. So the cash flow is determined when you take all the expenses that a company spent, and then you take all the profit and whatever, and then you subtract, and you still have some cash left for you. So some liabilities and asset, and then you get the cash flow. So those are the limitations for PE ratio. So that is the end of the video, and we have learned these two ratio as far now, and maybe we'll learn more ratios, and then it will start coming together, and see how important these ratios are, and what piece of information can you get when you are trying to determine the PE ratio. And then if you combine it with the price to sales ratio, the book value ratios, those one, and then when you put them together, you can easily make a good sound investing decision that can yield you profit. So that's it. Thank you for watching, and I will see you next time. Subscribe for more videos.